Good afternoon. We're just going to give it about 30 seconds. I can see lots of people connecting. And this is the joy of doing these live webinars. I'll just wait for everyone to connect. Okay, we're 1 minute past, so let's just kick off and we can welcome everyone as they join later. So first of all, Happy New Year. We are delighted to have you here. As mentioned, we are live today, and this is our first webinar of 2024 from IB Europe. So what better way to start the new year than by introducing Daniel Knapp, who is our chief economist. And this is a very special State of the Nation where Daniel is going to be looking at the forces that will be shaping and impacting our industry. So without that, I know that he's got kind of a packed presentation here. We'll be taking questions afterwards. So you'll see at the very bottom of your screen, there is a Q&A box. If you've got any questions for Daniel, just put those in throughout the presentation. And then at the end of the session, I'll ask Daniel. So Daniel, I'm going to go straight over to you. Make sure you have a sip so that you're all ready to
exactly. Well hydrated.
All right.
Good morning.
Thanks so much.
Hello, everybody. Great to be here. We do these sessions a couple of times a year, at least biannually, but probably quarterly this year, to provide a deep dive on the forces shaping the digital advertising industry, always with a focus on the economy and the advertising revenue data that is underpinning the industry. But we're going to look also to the left and the right to see what forces are actually contributing to this growth. So today, we have a presentation looking at the kind of well-known but also underappreciated forces shaping digital advertising in Europe in 2024 and beyond. And before I kick off, I think it's a bit of a Groundhog Day. The news that we see in the industry at the beginning of this year really mirror those of 2023. It's about uncertainty, the poly crisis, budget cuts, layoffs in the tech sector, etc. Nothing much seems to have changed. Yet when we look at recent advertising forecasts from agency groups and others, they seem to be more optimistic than these news makers suggest. So we've looked at a kind of deep dive. What's behind this? Can we confirm this? And what is the trajectory here? Is it really Groundhog Day? Is 2024 the same as 2023? Or can we, based on data points, see a trajectory and also create more certainty at the beginning of the year than we had in this really black box 2023, same time we did a webinar about the same year ago. So today I have 8 + 2 forces, 10 in total, that are shaping digital advertising today. I'm going to focus on 8 distinct forces, and then we can talk in the Q&A about the intersections between those forces. So that's the +2. And we start with a really macro overview, naturally, with the state of the economy and how the economy relates to advertising investments. Then secondly, we want to look at what's special in 2024, because it's an even year. Odd and even years historically have different growth trajectories in advertising due to one-off events. Think Olympics, think of football, think of often elections and so forth. And 2024 really is a bonanza of those events. So the question is, how, if at all, is that going to positively impact digital advertising in Europe despite an uncertain macro environment? Then we're looking at the state of digital. Is digital holding up in this world or not? How is it comparing to traditional media? And also, how is the European digital sector comparing to the global picture? We're then moving on to look at what I call a new advertiser logic, by looking at what are advertisers in their earnings reports and elsewhere saying about their ad investments with a particular view on digital. And we have, I'll come to that, devised a new method to really try to understand this at scale. This is global, but we trained an LLM to go through the earnings calls of various thousands of large companies, the top LH 200 advertisers, plus S&P 500 and others, to see what are companies saying, what is detectable beyond just pure hard data, but also in the qualitative comments they're making about the near and the midterm future, and what read-through can provide this to us based on our goal to find out what's happening in Europe. We must talk about retail media as well. But apart from the obvious growth story, I want to double down on the dream versus reality situation that we're currently facing and which factors are required to unlock the theoretical potential of this sector. I want to speak about a new value proposition. What does digital advertising really need to deliver to the wider marketing community to continue on its growth? Is it business as usual, same metrics, same approaches, or do we need to change what we're doing? I want to look also at agencies, how agencies have been performing and what kind of reinvention is required for agencies, in particular the traditional holding group model, to get ready for the future. And then lastly, of course, we want to speak about AI readiness and what we can already see, both on the, in a sense, regulatory side, but also on how AI and automation is affecting workflows in our industry. So those are the kind of the 8 forces, and you can see they are intersecting with each other. So there is clearly a +2, and we can certainly dive in the Q&A into additional factors because there are so many, of course. There is cookie deprecation, there is a change in the ad tech ecosystem, more direct paths, a move potentially, in some cases, we see away from the open market and so forth. So we can dive into that as well. So without further ado, let's speak about the economy. And the good news is that we believe that advertising overall will outperform a weak economy, but unlike COVID in 2020, 2021, 2022, digital advertising will not defy gravity and not be decoupled from economic growth. It's more grounded in the underlying fundamentals of the economy than before. Now, let's dive into kind of the latest IMF forecast from October 23. Other forecasts have come out from various other institutes, World Bank and so forth. The data vary slightly, but the overall picture, in a sense, the relations between the markets, the growth is fairly similar. So we see a global picture here, and we can see that overall growth in Europe is far more muted than in the rest of the world. We are still in the polycrisis, uncertainty, inflation, Ukraine war, you name it, energy crisis. Many things continue to affect the European economy in particular. Now, the good news is that you can see we're seeing a slight uptick. So some markets were in recession or kind of now even in technical recession in 2023 and beginning of 24. But forecasters see that there's going to be a slight improvement in the overall macroeconomic conditions, which should be good news for advertising, although it's not much, to be fair. Now, if we look at the European markets overall, and we have ranked growth here on 2023, we can see that in particular markets that were that are highly driving digital advertising overall, just in terms of their market share, have been suffering. So France, the UK, and Germany represent in total around 65% of all digital advertising investments in Europe. And those markets, France in the middle, but in particular the UK and Germany, which make around 50% of the market, have had a tough economic year in 2023. We do see some improvements, but you can see it is still behind some or behind many other European markets. So the question is, if the European digital ad market is so reliant on these 2 or 3 markets, can this macro picture really shift the market to growth, or are we reliant on the smaller markets whose overall weight won't be sufficient to sustain the type of growth we had in previous years? Now, it's not just about numbers when it comes to the economy, but also about perception and feeling. And what we can see here is data from the European Union. It's the economic sentiment indicator, which is a composite of both demand and supply, what's being manufactured, what's being bought, how businesses see the world, and also how consumers see it. And what we've seen in the last 12 months here, the data actually goes here. You can see the labels are not complete. It goes up until the end of the year. We can see this was kind of spanning an arc in the EU 27, where at the beginning of 2022, we had, in a sense, still a kind of muted optimism, still uncertainty. It did improve in the beginning of 2023, but then went down again. So in a sense, we are now, as we're entering 2024, in exactly the same situation with a muted optimism that we were about a year and a bit ago. So nothing much has changed. We can see, though, that different countries vary. For instance, we can see Germany, the largest EU economy, seeing a serious dip in confidence, which is sustained, and we will see that this will affect advertising growth overall in this country as well. But then some other things, like for instance, when we look at the Spanish situation, it's waves, but we have seen overall an improvement, and we can also see an uptick in other markets, for instance, from a very low basis here, but we do see an uptick on France, and we will also see how, in particular, the events like the Olympics are going to drive this up further. So it's a mixed picture if you look at individual economies, but overall, nothing much has changed. So we're still stuck in this polycrisis uncertainty limbo. When we look at how this translates into advertising, we've seen that ad forecasters like Group M have downward revised their forecasts. So here we can see a comparison of key European markets, Europe overall, the June forecast versus the December forecast, meaning that in many markets, some have been increased as well. We saw this in other forecasters as well. Think of the Netherlands and Spain. They've seen upward revisions. But in these large markets, we picked here the largest European economies and also the ones which are highly digitized, such as Sweden here. We have seen a downward revision of forecasts. But forecasters can't fully agree on what 2024 looks like. So if we do an aggregate analysis and compare Magna forecasts, Group M forecasts, and Denso forecasts, we can see different views of the advertising sector in Europe in 2024. For instance, we can clearly see that, lots of commonalities overall in terms of more growth between Magna and Group M, but very different assessments on France. And that's probably interesting because, of course, the Olympics are coming to France. So here, I think the key factor is how much will they drive advertising investment in the host country. But we can see that Denso overall has a far more skeptical outlook on the market than the other two forecasters. So there isn't really a consensus. So things when we have to continue to deal with uncertainty. A problem for digital advertising is that in this economic environment, it used to, in a sense, defy gravity. We had, coming out of COVID, two factors which really propelled digital advertising and made it relatively immune to the macroeconomic factors. We had an explosion of new business formation. Creating new businesses means we need to acquire new consumers. They were often digitally native businesses, etc. That has really boosted things. And also we had digital endemics investing heavily, partly new businesses, but also established businesses investing heavily in D2C models and fueling digital ads. So this has decoupled digital ads from GDP. But this bonanza has stopped. So the new reality is we're in a weak macroeconomic environment with a higher cost of borrowing. And we also have seen cracks, or more than cracks, massive breakages, in a sense, in the D2C model, because customer acquisition costs are so high and digital ad prices are so high that often these models by themselves are not sustainable. Plus, the digital ad market has significantly matured due to this kind of explosive growth we saw in recent years. So if we think about advertising money being finite, in a sense, if we exclude performance budgets, for instance, but overall, if we assume that digital advertising overall advertising is a finite pool of money, digital advertising has matured so much that we can't just, that we have to work harder as in digital ad industry to claw share from elsewhere or to get net new money, which wasn't advertising before, into the ecosystem. And this overall means, despite advertising likely outperforming overall GDP growth, that midterm digital advertising is going to correlate more strongly with GDP overall, so not immune to the underlying macroeconomic conditions anymore. What will help the market in this weak environment is, I mentioned it, a bonanza of one-off events, which are coming together globally to create potentially a spectacular investment climate. But is this really warranted? Just to highlight, we got globally a range of different events coming together in 2024, which are typically driving ad spend. Elections are driving ad spend in markets where, in particular, ad investments for political campaigns isn't too tightly regulated as it is in many European countries. We've seen the Copa Americana, the American football, soccer championship, the Mexico elections. We have in Europe, we have the Euro Cup, we have the Paris Olympics, and then in the US in November we have the US elections. And various estimates, some are ours, some are others, estimate that this will bring in net new money to the digital ad market. One-off money often. The problem with that money is it is not created in thin air, but what we often see, in particular in Europe, that this money is being reallocated, right? So either it's money that wasn't spent in 2023, which is then put into these 2024 events, or it's money that is taken from other parts of the year and focused around those events, or we're going to see kind of a slowdown in the next year. So this money isn't just new money, which is just there. It gets often taken from somewhere. And we all know that political events and sports events drive the digital ad market or the overall ad market a lot in the US. But the same logic, unfortunately, is not true in Europe. When we go back, for instance, to the London Olympics in 2012, the only medium that really saw a meaningful increase was out of home. When we looked back at the Euro Cup in Germany, we actually didn't see much incremental investment in the past, and last time it was in Germany, because advertisers were worried about competing too much with other brands and prices being too high. So actually they stretched their budgets throughout the year and did not focus it on this one singular event. And we can clearly see this if we look at these quadrennial drivers or even odd even year drivers in Europe versus the US. So on the right, we split advertising historically here the last 20 years. Odd and even years. Typically, you have those events in even years. And we can see in the US a strong multiple, right? But how much did even years in advertising outgrow odd years? Factor of 4.2. It's typically a boost for the entire ad sector, such events. However, as I mentioned, in Europe, the situation is quite differently. A redistribution of spend, so not net new money, but then often also a boost only for rights holders. So the question is it on public television, for instance, or is it on private broadcasters? And then a boost that's fairly localized, only for the host countries, or as we saw during the height of Spanish football, an ad boost if the team, for instance, in a UEFA Football Cup stays in the game for very long. So that's very hard to predict. So overall, the conclusion is we shouldn't rely too much on these events, on this political, or here in Europe, on the sports bonanza. The US really is the wrong reference. And we shouldn't think that what happens in the US and the positive news about sports events are going to translate into Europe. We have to be more realistic here. Now, the good news, apart from those events, is, of course, that in the last 4 crises that we saw, digital has outperformed in the past, right? We can see the dot-com crash, financial crisis, Euro crisis, and COVID-19, where online or digital always outperformed traditional media. We think, right, in this environment, macro crisis, this is going to be the same. Now, it's slightly different because if there is a boost on sports events, it's actually helping traditional media a bit more than digital. And this is what we can see in our latest forecast, our first forecast for 2024. You can clearly see that in 2023, traditional media were heavily impacted. We're seeing continued shift to digital. We're seeing systematic audience erosion, you name it. However, in 2024, we see that the sports boost, the localized, the smaller sports boost that we have in Europe is predominantly going to traditional media. So the performance gap between traditional and digital media is, at least temporarily for 2024, narrowing. Now, the good news is that digital still outperforms, and we currently expect digital advertising across all channels and formats to grow by 7.9%, which, given the uncertainty of the economy and also given the growing maturity of digital advertising, is welcome news. Digital ads, we think, will hold up well, as evidenced by the 7.9%, but more nuanced by new channels and also international growth strategies of enablement companies, and we can see that in a second. So if we split things out by format, so here we have the same formats as we have in our annual AdX report, we can see there is, in many cases, slight slowdown compared to 2023. We now have very easy comparatives in Q4 2023 compared to Q4 2022. So that's going to fuel a little bit of ad spend still in 2023. And these comparatives will progressively get tougher in 2024. So there is, in a sense, a mechanical effect in here as well, on top of the maturing of the ad sector. But there are, I think, two standout components in here. First, retail media, where we're actually seeing a strong acceleration. 2023 was a bit of a lull, as it takes time for digital offerings in retail media to mature, for partnerships to roll out, for budgets to migrate, etc. But we're seeing a range of new launches coming in 2024. And also we see strategies maturing. Retailers going beyond the sponsored product ads to other ad formats, embracing offsite, clean room partnerships with other media owners, etc. And in more countries, we're seeing launches of retail media offerings, and some of the largest retailers in Europe have only just launched or revamped their retail media offerings at the end of 2023. So this is going to give a boost. We're also seeing non-social video growing more strongly. It was not growing that much in 2023. We saw slower growth on YouTube, for instance, and others. So we're going to see a slight, a more increase in 2024. And also, I think once Amazon Prime Video and the ad offering comes in, not available in all countries, it's going to give an additional boost. We see other sectors quite healthy. CTV. Still growing strongly, only second to retail media. Social media, social video, we're going to see continue to grow as well. And in particular, as brands are investing in shoppable ads, some call them brand performance ads, i.e. ads where you have a brand exposure, but you can directly shop, etc. We see the audio sector, digital audio, which used to grow incredibly strongly, was the fastest growing format for us in our AdX report in 2022. Growing both in 23 and 24, a bit slower. So we're just barely touching a market size in 24 of 1 billion euros, which is still around about a tiny fraction of the overall digital ad market. And we're going to see search and classified and directories slowing down and maturing significantly. In this environment, if we abstract a little bit and compared to global data, so we have with our forecasts here for Europe, and then we have the global digital ad forecasts here from Group M, we can see that Europe is actually growing stronger than the global market. So a slight shift here from 2023. We believe that Europe is performing better than other markets, particularly if we exclude political events in the US. We can also see the Chinese economy stuttering. So we see Chinese advertisers actually moving away from the domestic market and investing elsewhere in the world. And Europe is also taking a benefit from this. This is sometimes hard to calculate. We can only make estimations. as it's often not very transparent where that money is coming from. And also it varies how companies allocate those investments when, for instance, European eyeballs are targeted, but actually the investment is coming somewhere from outside Europe. So there are different perspectives. But we can see these dynamics, these outperformance dynamics of Europe versus the global sector. We can already see this manifest in some ad tech earnings reports in 2023. So if we look here at the kind of 9-month revenue growth by region, just 3 examples here, Magnite, PubMatic, and the Trade Desk, we can see either the international segment or the EMEA segment. In the international segment, EMEA is often strongly represented, outperforming the US. Clearly, we had political events in the US in kind of Q4 2022, so there is a comparative effect here. But overall, we see that the relative lack of maturity in the ad tech sector in Europe compared to the US means that international expansion is a viable strategy, and we expect continued growth here in Europe in 2024. We can see this also, the numbers aren't that clear, but in other reports, if you think of DoubleVerify, for instance, in their measurement segment, the global segment grew by around 32%, whereas the EMEA segment grew by 75%. So strong differences here. This was mainly due to measurement around social, but it shows that, in a sense, advertising-enabled services based on data, based on algorithms in Europe are outperforming a global or at least a US benchmark. If we move away from the economy and from, in a sense, what's happening inside kind of the transaction layer of advertising, more towards the logic of advertisers, we can also see some interesting comments on 2024. The overall issue we still have everywhere, but in particular in Europe, is that the overall data economy is growing, but advertising is still very siloed. It's often not part of the overall digital growth infrastructure that companies are deploying. Here is some staggering data from the European Commission on how large the, in a sense, data economy is going to become, but advertising is very siloed. It doesn't really sit yet horizontally in that economy. But what we're seeing is, with advertiser strategies, a change, how digital advertising, data-enabled advertising, moves from being a silo to more deeply integrated in overall corporate digitization and growth strategies. And this is going to be a catalyst for further digital advertising growth, despite the weak macroeconomic environment and the high share of all media that digital already has. I showed this slide to some of you before, but I just want to recap because it's so important, because it really illustrates the changing logic and the pressure that advertisers are facing and why they're increasingly turning to digital advertising. But here is, in a sense, a snapshot of CPG companies. We don't have to go into details. Of course, green is good, red is bad, of revenue growth projections, margin projections, cost of goods sold projections, etc. So it's tougher going in the future. The pandemic bonanza and the previous Goldilocks era, what economists call when there's smooth sailing, when there's low inflation, high household savings, strong consumption, good GDP growth, and so forth. These factors are over. So the kind of near future expectations are far more muted. So companies need to work harder, save costs, but at the same time, grow further. How can they do this? We see this increasingly happening through, in particular, digital ad investments. What you can see here is something new that we have tried. There are so many different companies that are, of course, investing in advertising. We can't really read through all of their earnings calls or to understand exactly what each of them is doing if we just, set aside some Kantar, Nielsen data and so forth. But to get into the logic of their investments and also what they think qualitatively about how they look at marketing investments in the future. So what we did is we trained a large language model and went through the corporate filings, in particular through the earnings call transcripts of large advertisers. We started with the Ad Age 200, expanded to, filled it up with other S&P 500 companies. Then we looked at European HQ companies to kind of change the sample. And now we have around 1,000 plus 1,100 or so companies in our sample. We're building this out further, but I want to share with you today a first kind of snapshot of what we can glean from this information. So not everybody talks about advertising investments with a view to the future. But here we have a list of around 60 different companies grouped in different segments, from luxury over CPG to furniture. And we looked at what are they saying in terms of marketing investment in the future, future-directed marketing investments. And we just scored this on a scale from 1 to -1. Is it a very positive statement? Can we see terms like growth, continued investment, etc.? Or do we see statements like we're cutting budgets, we're economizing, etc.? So we codified this information. And what we can see, I think, is something quite remarkable. We can see many of these companies, and if you look at the list here, you can see it's a mix of some of the largest advertisers, but also a diverse range of different sectors that in most cases, this is green. A little caveat here, the companies often don't specify exactly in the qualitative statements what time horizon they are specifically referring to. And we can see that in some quotes I'm going to show you on the next slide. So partly this refers to Q4, but very often it is more of a midterm view, a general approach that they're taking to marketing expressed in a longer term strategy. We can clearly see some sectors seem to be, sample sizes vary here, but seem to be immune to economic headwinds. No surprise, luxury, for instance. We also see good signals in pharma. We only have like one telco company in our sample here, Vodafone, but I think very, very interesting in particular is CPG, a segment, of course, key underwriter of the ad economy overall. The companies that are very large have a high share of overall revenue reinvested in marketing, and they talk a lot more than others about what they're doing in marketing. So we have a strong sample here, and we can see most of these companies are expecting to invest further in marketing. Travel, also fairly positive, a mixed bag. Fashion, same thing, and then we kind of see things decelerate. It does make sense. Auto industry affected, insurance, and of course tech industry, where nearly all of the tech giants are economizing on marketing investments, and you can also see that in the revenues of agency groups, which are highly reliant on this tech investment. We saw this already; they were underperforming in 2023, and we expect similar trends happening in 2024. Also, media and entertainment under pressure, and then I think the sample on energy and furniture is too small. But this gives us, I think, a first read that different companies or that different sectors approach advertising investments very differently and have a different view of how these investments are going to look like in the future. To give this a little bit more color, I want to show kind of the underlying text that we have extracted that is being used to codify this previous slide into kind of quantitative information. Example here, Mondelez, large CPG. I picked out two statements from the recent transcripts, and it's really all about digital. Company investing in new growth channels, customized, targeted social and digital media, and also a major investment in digital services overall. Right. So here you can see this combination I mentioned earlier, advertising moving away from something siloed to being embedded far more in the overall company's digitization strategy. Beiersdorf, Nivea, and other brands, similar. They see results, however measured, from digital advertising. We see this in different markets. Here's an example of France. So you picked out a European market. Strong digital campaigns have led to a 72% increase in online sales. And then kind of more long-term validation, digital first approach to communication, to TikTok is playing out, i.e. a validation. And we see this as something that this is what the company is going to continue to do in the future. Coca-Cola, massive company, we can see has shifted media towards digital. Digital now over 60% of spend, up from 30 in 2019. Expect this to continue at a smaller pace, but we can see the company plans to continue investing ahead of the curve in marketing. So we don't know, is this Q4, is this longer? But we read the statement as something that is not dedicated to Q4, but something that is more of a general midterm outlook, an expression of strategy rather than tactics. Similarly, let's move to Burger King. We can see costs for marketing as percent of gross were lower, but the company has actually refined its performance tools and building marketplaces, etc. So again, here a combination between advertising and the overall digital strategy. And what we can also see is that changes in sectors accelerate the shift to digital. It's a complicated story in a sense, but I think if we walk through it, it will become quite compelling. We've seen lots of articles out there in specialist trade publications, The Information and others, for instance, about M&A frenzy and acquisitions in the beauty and CPG space in particular. So we've seen lots of VC investments in beauty startups globally. We've seen an explosion of types of content, screenshot here, hashtag get ready with me, massive kind of makeup and getting ready videos on TikTok, Instagram, other vertical video platforms. We can see that younger consumers are not necessarily buying the conventional beauty products or personal care products on the shelves in supermarkets. And many of the companies, think a Unilever and a Procter, they are in a sense what I would call M&A native. They're conglomerates built up by acquisitions. So they're buying a lot of these new digitally native brands that are catering young consumers. What they're also doing is they are moving them from an online, from a D2C model to a model which includes, not substitute, but includes positioning them on the physical retail shelves. As I mentioned initially in my presentation, the kind of D2C only model fueled by advertising, extremely high customer acquisition costs, has turned out to be a pandemic fantasy and isn't really working. So these brands are becoming more physical. But there's a paradox here. Of course, this could mean that for these brands, digital ad investment is going to be lower. However, what we see is happening that to grow these brands, the pool of money available for them is growing over, ad money is growing overall. So we can see a diversification in terms of, moving beyond digital, physical ads, probably TV ads, etc. But the paradox here is not only do we have more ad spend overall, but because these brands are digitally native, the integration of these brands into the corporate portfolio is a further catalyst for overall digital strategies and also for digital advertising strategies in companies that are rapidly digitizing their ad approaches overall. So we see this paradoxically as a positive driver for digital advertising. Now, how is this being activated? I think there was a great chart recently from Miles Younger at the University of Digital, which really, I think, illustrated a sectoral shift in how brands are using enablement technology to acquire customers and to run their digital advertising. Speaking about silos again, we typically had a world where brands, other agencies were logging into a DSP in the cloud and running campaigns there. Within that DSP, within that interface, relying on their reporting metrics. In a world where advertising becomes not a silo, but part of an infrastructure, where the first-party data is becoming more important, we can see that ad tech is getting more integrated with the proprietary cloud environments that these companies have. This means that it's likely going to be easier to measure campaigns, to activate them to control them, and also to add new data. So this changes how I think the ad tech ecosystem is set up, and also enables brands to do more with digital and advertising than before in a siloed world. A key driver for this, of course, combining first-party data, measuring outcomes, has been retail media. And you've seen the forecasts we've put out on retail media, which are fairly optimistic. We believe in the potential of retail media, but we can also see in 2024, a lot of work has to happen for this potential to really become reality. A brief recap. We can clearly see that if we compare the US and Europe, Europe in retail media is lagging behind. So here we have around 80 companies, and we look at retail media as share of online GMV. Not a perfect metric, but a metric that has become as commonplace in company reports and in financial parlance about retail media. The remarkable thing, as we break things out, look at last mile delivery and marketplaces, that Europe here seems to be far more advanced and more competitive towards the US than in the essence classic retailer world, i.e., let's say brick and mortar stores that are digitizing, etc. The key thing, of course, is both for last mile delivery and marketplaces, advertising is essential for brands. It's more of a tax than something else. If you don't advertise, you don't sell. That's different when it comes to retailers. And also retailers often, as not digitally native organizations, struggle more to actually reconcile an e-commerce business and an e-commerce logic and a retail media logic. Plus, there are capital costs, issues about expertise, becoming a publisher, building ad ops capabilities, and so forth, which are hampering the growth currently. Overall, we still see retail media growing strongly. With a previous forecast, 2026, where we are expecting 25 billion, including Amazon, we have revised this forecast and see this 25 billion being realized about a year later in 2027, but it's still a very large market. It's larger than the overall CTV market, which we think stands around at 3.5 billion euros in 2023. If we factor out Amazon, we can see, well, CTV is still slightly larger than retail media, but it's still at 2.6, ranging now to a 3.8 billion euro business. Amazon has run a share of 70-75%, depending on the market. If we dive into markets outside Amazon, we can see the UK is leading, with Germany following closely, then France, but we can also see, based on strong endemic players, Netherlands and Poland are punching above their weight, whereas very large media markets like Spain and Italy, still some of the largest TV markets in Europe, are actually lagging behind, so significant potential. And this is also reflected in the compound annual growth rates we have ascribed to each market, so more growth happening there. Plus also in other markets, we see in particular in Eastern Europe, retailers building capabilities, and also in the Nordics. But to grow further, retail media needs to combat fragmentation. We're now counting over 100 retail media operations or networks, however you want to call them, across Europe. And we see three emerging scaling models for consolidation, which we think is vital for this growth to continue, as not every retailer will be able to afford costs. They've just bought a CDP. Now they need to potentially buy a clean room. Can they really hire ad ops people? Do they have enough skilled hands on keyboard to run offsite campaigns? Can they really, do they have a powerful sales force, etc.? These are all issues. So model number one is what we call Retail Media Alliance, some kind of ad network 2.0 in a sense, layered over with some technology. Unlimitail, initiated by Carrefour, I think here is the best example. And the remarkable thing, I think, also for media owners here, that this is not just a retail-centric alliance, but it also, of course, includes media owners. Media owners as key outlets and contributors to scaling offsite retail media beyond social. The second model we can see is white label commerce, and the protagonist here is French player Cnova, a unit from the retailer Cdiscount. They have a white label marketplace, which they're selling to other retailers, predominantly in Latin America, but they also have baked in ad monetization as a service. So in a sense, you buy the marketplace and you can switch on with a flick of a button ad monetization. This is a growing business model. The last one is still emergent. It's not there yet, but I call it retail media as a service. This would be either in a large vertical or very large retailers who have built their own ad tech stack, who have their own experts, ad ops experts, other kind of ad trafficking, kind of hands-on keyboard, etc., providing both technology but also sales capabilities, platforms, etc., to other retailers. I think there are a few contenders who could do this in the future, very large ones right now, but you could do that for one sector, for instance, as well. And in a sense, retail media as a service is a combination of the first and the second model. And we believe that those models need to develop quickly, and more retailers need to get involved in these in order for growth forecasts to really be realized. We need some kind of Europe Inc., some kind of alliance. And it kind of very much mirrors conversations that in the mid 2010s around publisher alliances. But this, of course, goes further because it's a much deeper level of technical integration with much more data and not just, in a sense, sales house capabilities. Retail media has massive potential. And I think there was a great article by Paul Frampton-Calero in the Retail Gazette in November. And I tried to illustrate on a chart what the real potential, what the end game is. So retail media here as a central evolution in the business model between retailers and manufacturers. So typically, in a sense, you had the manufacturer, this would be the shampoo provider, etc., selling stuff for the retailer buys it and sells it, but gets a discount because there's some trade marketing involved in this. So it's a fairly linear relationship with a little bit of, in a sense, a marketing layer on top of it. In the future, this is likely going to look different, where you both buyer and seller relationships at the very same time, where apart from the retailer buying the product, it's also a seller of key intelligence and media to develop products, to test which products work, product testing, fake door testing, all these different things. So potentially the future is going to be a virtuous cycle between manufacturer and retailer who both drive product sales and product innovation. The problem is we are not there yet. We're just really in the first chapter of retail media in Europe. We don't even have proper clean rooms installed yet. So a lot of work has to happen for this model, this pipe dream of retail media, to really become unlocked. And we think that partnerships and alliances are a key way to getting there. Overall, we think our industry needs a new value proposition to grow further. Growth in the future will not come from doing business as usual. We can clearly see that digital advertising now is the vast majority of all media advertising. So there is, in a sense, little money left to migrate from other channels to digital. Digital needs to work harder to attract advertising euros. However, long-term erosion of traditional media continues, and we can see this by the European TV ad market growth by quarter. We did all the listed companies and also did modeling on others. After a pandemic rebound, we quickly saw a long period, a long valley of depression here, and we believe that despite easier comps, Q4 2023 is also going to be tough. So there is going to be, from a media owner perspective, a lot of pressure, and we see instead digital pure plays globally, here you can see them ranked, grow stronger. This will also affect Europe and make it harder for media owners who are not partnering, for instance, with retailers and others to unlock future growth. However, this is not a kind of, in a sense, natural machine of taking share. We need other metrics and better measurement to really unlock the potential of digital advertising. We can see this partly by enablement services already outgrowing the market. So this is kind of ad tech growth, 9 months 2023. A list of companies here, total, and then Brian Weiser had the good idea, I think, to call a composite set, which is just a set of 8 companies that are not involved primarily in selling media, but primarily in providing services for data and algorithms. So this is stuff that is continuing to grow the market, and despite the troubles and the woes in the ad tech market, we see this trend going to continue. But this often comes, this growth is not necessarily reflected in media owner revenue. So the market needs to work harder with new metrics to really validate what value advertising is delivering, in particular as companies are looking for efficiencies. And we can see this, I think, many of our audiences, but clients want outcomes. So media, not everybody can offer, in a sense, some call it manufactured outcomes, but in a sense, very kind of bottom of the funnel outcomes. But I think all media channels need to deliver more than just eyeballs. The problem is, often, even in the case of retail media, which in a sense is often branded as the quintessential outcome medium, the outcomes are already priced in CPMs, but they're not being fully delivered. So a medium is being defined as an outcome medium, but we often don't see the business outcomes yet, which means it will be hard for retail media, but also for others to grow media CPMs if they are already positioned as an outcome medium. More needs to happen. We need those outcomes to be delivered in reality. Otherwise, I think it's just going to be, in a sense, these algorithmic black box services, PMAX and others, which are going to continue to grow market share. This value prop, I think we can clearly see in different phases of the ad industry, right? We had the phase of performance display, performance search, and then we had social video programmatic coming around, and then a verticalization of search. But often the metrics attached to that were easy to measure metrics, quantification over substance, you could slightly critically call that. And we need to really build out better metrics. It could be attention, it could be cross-channel attribution, other things, moving more to the sales and even for awareness media, which are usually positioned at the top of the funnel. Agencies can play a key role in this, in a sense, as hubs of connecting retailers, publishers, and advertisers. But the conventional agency model, the holding company model, bundling creative services and media, but in a sense, having separate P&Ls for those and siloing them, is under pressure and needs reinvention. We can see this again if we look at Q3 revenue growth, a stark difference to the money potentially available in the market in digital advertising, media owners, but also in service enablement versus what agencies are currently generating. So agencies need to work on overcoming this divergence. And this could be since integrating creative through creative optimization and media buying more closely, and also providing other services that go more into the ad tech sector. And I think what really illustrates this really well is this book, and there's a new one now by Michael Farmer with this morbid title, Madison Avenue Manslaughter, where he took a really, in a sense, a discompassionate, if you will, accounting view of media agency value creation and remuneration, where he packaged every stage of delivery of an ad campaign, from the briefing to the creative and so forth, and priced it. What is the agency getting for that? And we have seen a price erosion that has led to this toxic cycle of more work required, a more complex environment with more channels, more systems, but actually less money generated per unit of that work. And it's crucial for agencies to break through this cycle. Lastly, I want to speak about AI briefly. We see that a lot of talk is there in earnings calls and everywhere, but the talk trumps the impact for now. Yet, if we thought that GDPR and e-privacy were key complicated issues in Europe, AI is going to be a very different dimension. We know it's top of the agenda for the ad industry. We look at the earnings calls right here, mentions of AI in various forms. But we can also see that along those mentions here, there is a growing interest in actually ethics of AI. This is kind of not just regulation, but in a sense, pre-regulation. How do we deploy this in an ethical manner? And a good bellwether here is actually the paper submitted on the largest, globally largest conference on AI ethics. Not only have we seen an explosion of the volume of papers submitted, but also industry is now taking a key role. I believe the ad tech industry, or all of our industry, needs to play a stronger role here, also in Brussels in particular, to ensure that we can build really AI-enabled business models. Often there's talk of disruption for AI. Here you can see designers and architects working before the invention of CAD software, very manual. you could have assumed that the rise of Excel or CAD software would have disrupted this industry and caused job losses, but it didn't. It created more jobs and increased productivity. And let's go back to the world of programmatic, just as an anecdote, because I believe that AI enables a lot of job creation in digital advertising. We can see correlation isn't causation clearly, but we can see a relationship here, interestingly, between the employment in digital ad agencies and the programmatic share of display ads run together. So programmatic didn't destroy jobs, it created different jobs, required different skills. It's likely that something similar is going to play out in the world of AI as well. And with that, I want to finish my 8 trends with some intersections, interdependencies you saw. And Helen, maybe we can use the last remaining minutes to discuss those +2 and address any other questions. Thank you very much.
Thank you so much, Daniel. Do you want to take a sip of your drink while I just have a quick look at the question? So we've got a question here. We're about 3 minutes, but if you could quickly summarize, what do you think the impact of the upcoming DMA changes as well as cookie deprecation will have on maybe some of the trends or the outlooks that you've seen?
But let's start with cookie deprecation. I think many are not ready for this yet. We often thought that it's not going to happen, but it's definitely going to happen. What we are seeing from some of the early tests is price erosion in the open market. This will probably stabilize and increase again when there's more testing. The key issue, I think, is there's going to be more work required on the buy side, and particularly on the agency side, to kind of act as orchestrators and see how can we recreate the audience scale now in a very fragmented world, because there is no one size fits all, from cookies to topics to protected audience APIs to contextual approaches. They all need to work concurrently. And often what we're seeing now is testing and investments in single technologies or approaches, rather than comparing and benchmarking them. So I think that's a key task for the industry to bring this more together. Very briefly, very complex topic. I think regulation is going to get more intense. I just say from DSA and DMA, for me personally, the most interesting thing is kind of platforms reporting user data. So that helps me build better models. So I primarily see it for me now as in a sense as an exhaust pipe for better data.
Great. And then in the last minute, anything, did you want to quickly, very briefly discuss those final 2 forces, trends that you'd put to the side?
Yes, so I think one thing it's related to the cookie question is in programmatic. We're seeing a shift currently away from the open market to more PMPs or programmatic guaranteed deals, which in the past really struggled to scale. But I think with new curation technologies, we're going to think this advance more. So more kind of programmatic direct integrations, a compression of the value chain. And I think there's a huge chance, I think, for European media owners as the long tail of digital advertising becomes trickier to measure, to really up the data game and absorb more of that long tail. So I think there's going to be in a sense a compression of the long and the mid tail, and the chance for premium providers of audiences.
Perfectly put, Daniel. We've got 1 minute to go. That's great. So I'm going to give you've spoken non-stop for the last 59 minutes. So thank you so much for this. As Daniel said at the very beginning, we love doing these and providing these kind of on every few months, because this takes an awful lot of work from Daniel's side. Just wanted to note a big focus, as we've been talking about this year, is AI. So we're currently running this survey that you can fill out now. There's a QR code on the screen. And this is just looking at the level of understanding within AI, the usage. So it's a really good kind of benchmark for us just to see where the industry is at with this. So we'd very much appreciate it if you could take the time. We'll be sending the wrap up of this presentation and also the recording to everyone that has registered today. And then if you are an IB Europe member, you can contact me directly. It's massad@ibeurope.eu, and we will send you the full deck, but it's just exclusive for IB Europe members. Okay, thank you so much. Big thanks, Daniel. And thank you for everyone who joined us live today. Thanks. Bye-bye.